Alright, today we're going to be looking at pricing, some brief exercises for our managerial accounting. So during the current year, we have Breyer Corporation expects to produce 15,000 units and has budgeted the following: net income $500,000, variable cost $800,000, and fixed cost $700,000. It has invested assets of $2 million. The company's budgeted ROI, meaning return on investment, was 30%. What was its budgeted markup percentage using a full cost approach? So the first thing we're going to do here is look at what is the return on investment of each unit. What is our desired return on investment? And to do that, we're going to take the amount invested times our ROI percentage, and then we're going to divide that by the units. So first we're going to look at our desired ROI per unit. And we're going to take the 2 million, this is the amount of our internal company assets that we are going to invest in this project. And when we invest these assets, we want a return on our investment of 30% in order to do this project. We anticipate we're going to make 15,000 units. Alright, so the 2 million times 30% is 600,000. Divide that by the 15,000, and we have $40. So for each unit that we sell, we would like $40 of a return on our investment. Now, that's not the answer to the question though, because we're looking for the budgeted markup percentage, but we needed to know what was the return on each unit in order to calculate. So now I'm going to look at what is our total unit cost. How much is it costing us to make this product? So our total unit cost is computed as follows. We see here that our variable cost is $800,000 and our fixed cost is $700,000. So if we add these together and divide those by our anticipated 15,000 units, we're going to have $100 of cost per unit. Okay. Now we have enough information to calculate what our budgeted markup percentage is. So how we're going to calculate this is we're going to look at what is our desired return on investment per unit, and then we are going to divide that by how much the unit costs us to make. So we know that we would like to have $40 of return on our investment, and if it costs us $100 to make the product, then our markup percentage is going to be 40%. Alright, let's take a look at our next one. We're going to use a little bit of time and material pricing to determine a bill. So we have Maylee's bicycle repair charges $28 per hour of labor. It has a material loading percentage of 30%. On a recent job replacing the rear wheel and sprocket of a racing bike, Maylee worked 8 hours and used parts with a cost of $450. Calculate Maylee's total bill. So now, when we're using time and material, we're going to have two different rates for calculating. The first one is how much is our labor? How much did the time cost that we put into this? And the second one is how much of the cost and markup are we doing on our materials that we use for the project. So first we're going to look at the labor. Our labor charge is $28 per hour, and we worked 8 hours. So we have $224 that we are going to charge for the labor. Now, we used parts that cost us $450, so here's our labor, and then here's our parts. And now we have to do the material loading percentage. And so this is covering some of that manufacturing overhead costs, or just the overhead that we need to look at, the shop that we're in and whatnot. So on this one, it says that we're going to do a loading percentage of 30%. Okay, so I'm going to take my parts of 450. So a material loading percentage, it's going to be 30% on the materials. So that would be our parts in this case. So I'm going to take the 450 times the 30%. And that gives me $135. Now if I add all of this up, our total is $809. So this would be the total bill for Maylee. This one here. Alright, next let's look at determining the minimum transfer price. So we have different departments or divisions within a company, and we're going to be transferring product from one to another. What should we charge? So the memory division of Shelly International produces a computer memory element that it sells to its customers for $30 per unit. Its unit variable cost is $18, and its unit fixed cost is $7. Top management of Shelly International would, like the memory division to transfer 7,000 units to another division within the company at a price of $21. The memory division has sufficient excess capacity to provide the units. What is the minimum transfer price that the memory division should accept? Okay, so it's going to cost us $18 to make this product. So we know that we don't want to go any lower than the $18 that it's going to cost us, because that's the variable fees that we're going to need. Now, this unit fixed cost is $7, but a fixed cost we're not going to take into consideration here because it's fixed. It's a sunk cost. We aren't going to take that into calculation right now. Now, so we're looking at our manager would like us to transfer them for a price of $21. So is that reasonable? Can we do that? In this case, because our division has excess capacity, then its opportunity cost is zero. We're not giving up anything to do this order. We have the capacity to do it. So we have zero opportunity cost. So in this case, our minimum transfer price is going to be the $18. We'll look at in a moment here of what happens if we do have an opportunity cost. So our opportunity cost is zero, so our minimum price is $18. Now let's look at what the minimum transfer price should be for a special order. So now we're using the data from the previous question, but we're going to assume the units being requested are special high performance units, and the division's unit variable cost would be $21 rather than $18. And our division is operating at full capacity, so we would have to stop making something in order to do this. What is the minimum transfer price that the memory division should accept? In this case, the minimum transfer price is going to be equal to the division's variable cost plus its opportunity cost. So our minimum transfer price is now going to be our new price of $21 for the variable cost, right here, the $21, plus our opportunity cost. So what is our opportunity cost? We're going to have to go back up to our original information. We can sell a memory element for $30, and the variable cost to make that is $18. Well, in order to make this special order for our company, we can't sell that $30 unit outside. We have to make less units to fulfill this. So our opportunity cost is going to be the price that we could have sold it, less the cost it took us to make it, and that's going to be, so 30 less 18, gives us 12, okay, which is also the contribution margin for this unit. So the 21 plus the 12 is $33. And in this case, since we have to give up making those units, the minimum transfer price should be $33, since we're taking into account our opportunity cost.